Hey, I'm Jonathan Wild, and we are going to cover how to use weighted average for inventory costing under a perpetual inventory system. The weighted average, or average cost method, involves computing weighted average cost per unit of inventory at the time of each sale. That average cost is then used to compute cost of goods sold for that sale. For example, let's say a company bought 3 identical units of inventory. 1 unit on June 2nd for $10, 1 unit on the 4th for $11, and 1 unit on the 25th for $15. On June 28th, we sold one of those units for $21. To compute the weighted average cost per unit, we take cost of goods available for sale and divide that by the number of units available for sale. In our example, we add the inventory costs of $10, $11, and $15 per unit to get cost of goods available for sale of $36. We divide that by 3 units to get an average cost of $12 per unit. Because we sold 1 unit, we report $12 as cost of goods sold on the income statement. And because we have 2 units left in inventory, we multiply that by the $12 weighted average cost to get $24 reported on the balance sheet. The weighted average method can only be used when our inventory consists of identical units. For example, if we are selling identical gallons of milk, we could use the weighted average method. However, if we are selling one-of-a-kind custom cars, we would not use the weighted average method. Okay, let's do an example. Assume our records show that on May 1st, we had 20 units in beginning inventory that had a cost of $30 each. We fill that information into our table under beginning balance. On May 3rd, we purchased 30 units at $35 per unit. Now, looking at our inventory balance, we see 20 units at $30 each from beginning inventory and 30 units at $35 each. If we multiply the number of units by their costs and add them together, we get 1,650. To compute weighted average cost per unit, we take the 1,650 and divide it by units available for sale, which is 20 plus 30 units or 50 total units. This gets us a $33 weighted average cost per unit. On May 5th, we sold 35 units. And using weighted average to compute cost of goods sold, we take the 35 units sold and multiply it by average cost per unit of $33. Next, look to inventory and see that we have 15 units remaining with an average cost of $33 each. On May 11th, we purchased 5 units at $45 per unit. Now, looking at our inventory balance, we see 15 units at $33 each and 5 units at $45 each. To compute weighted average cost per unit, we take the $720 and divide it by units available for sale, which is 15 plus 5 units or 20 total units. This gets us a $36 weighted average cost per unit. On May 28th, we purchased 10 units at $48 per unit. Looking at our inventory balance, we see 20 units at $36 and 10 units at $48. We then take the $1,200 and divide it by 30 units available for sale to get a $40 weighted average cost per unit. On May 31st, we sold 25 units. And using weighted average to compute cost of goods sold, we take the 25 units sold and multiply it by average cost per unit of $40. Looking at inventory, that leaves us with 5 units remaining with an average cost of $40 each. Last, we total our cost of goods sold to $2,155, which is reported on the income statement. We also see we have 200 left in inventory at the end of the month, and we report this on the balance sheet.